Hello, everybody. My name is Bennett Tchaikovsky, and welcome to financial accounting. This is a problem I'm going to be going over here for the first exam. Without saying anything else, any opinions expressed herein are those of myself and not my employers, including but not limited to Irvine Valley College and the South Orange County Community College District. Any opinions, dad jokes, whatever you hear in here are the result of my own work. Take it as it may, and let's roll with it. So, when you take when you take the very first financial accounting exam in my class, about two-thirds of the question for exam one is really going to be a large problem. Why do I give problems? It's because it is by far the best way to learn. I give partial credit. And so basically, by going through and doing it this way, it basically enables me to give you hopefully a pretty fair exam. Taking a look over here at this particular question, and there's going to be some things I just kind of want to point out and just kind of help you observe this. Really, what I'm trying to kind of go here through and do is we're basically doing recordings of assets, liabilities, owner's equity, revenues, and expenses. We're just recording these basic. We can also throw in here revenues, expenses, and dividends. And what I'm really looking to do is to give you a foundation whereby you can look at these transactions, you can post them into the T accounts, you can then make an unadjusted trial balance, you can then prepare an income statement, prepare a statement of retained earnings, close out temporary accounts to retain earnings, prepare a post-closing trial balance, and then prepare a balance sheet. Knowing how to do this for this first exam is absolutely critical because we're going to be building off this on exam two. On exam two, what I would do instead of having a lot of these transactions be on December 31st, 2029, I would then basically come up and say, okay, now it's going to be on October 1st. But I don't do that specifically because if I did do that, then you would have to deal with things like interest expense. So let's also kind of look at this when you do come into when you do get to the exam. One of the things you're going to see is I will give you the accounts you can go through and use. I will go through and label T accounts. I will probably go through and give you more accounts than you actually really need. Again, it's an exam. That's how I'm kind of going through and testing you, but you'll get these parts of it. So when you're going through and preparing for my exam one, what's really critical that you do is you go through all these questions. The way you're going to learn accounting is by taking out blank sheets of paper, handwriting out the solutions repeatedly. You can sue me for carpal tunnels, whatever you need to do. But in all seriousness, you learn accounting by practicing, and accounting is a skill, and that's what we need to learn. So let's go ahead and get to it. Now, one of the things I also want to do before we go through and record things in T accounts, some of you might be saying, well, Tchaikovsky, why are you going through and teaching us this way? Because the T accounts are by far the best visualization on how to record transactions. And if we look at our balance sheet equation, right, we've got assets are equal to my liabilities plus my owner's equity, right? And this is really the format. When I look at a balance sheet, right, what I'm basically seeing is right over here, balance sheet format, and this is going to be consistent for all companies. Just give us a second. There we go. Okay. So if I look at a balance sheet, you're going to see assets, total assets, liabilities, total liabilities. Then you're going to see over here equity, and then you're going to see total liabilities and equity. This is the balance sheet equation. However, on this one here, what you're noticing is that, well, they're not the way we're going to make a balance sheet is going to be different than this type of balance sheet. It's because before exam one, we're making an unclassified balance sheet. What does this mean? We're just going to list out assets, liabilities, and then owner's equity. We're not going to care about when these obligations or when these assets are going to be used. So again, the purpose of this very first exam, again, it's not very realistic, but it is very important because you need to know this foundational part. But if we look at how we would go through and record transactions, if I take AELOE, and then I have over here DC, what's our nation's capital, where crazy stuff happens every day. It's Washington, DC, or debit credit. Why is this so important? Because if I go through here and I look at this, if I isolate it, we would say that assets typically have debit balances. Assets are increased with debits. Assets are decreased with credits. And many of you might be jumping into the conclusion of, oh my God, I got to go through and do a journal entry. Absolutely not. I'm going to break down a transaction for you a little bit later on today that will show you what it looks like with a journal entry. But for right now, let's kind of stick with this. And conversely, over here, for my liabilities and equity accounts, basically my liabilities and equity typically have credit balances. Liabilities and equity are increased with credits. Liabilities and equity are decreased with debits. Okay. Last overlay is where do I not want to end up on the weekend? It is going to be the emergency room or expenses, revenues. Okay. And very simply put, we're going to go through and basically record expenses with debits. And we're going to record revenues with credits. And this is going to be in general in terms of how we're going through and doing this. So whenever we record a transaction, we do have to go through and follow these rules. So what you're going to see me doing throughout this, demonstration. And again, many of you are now watching on me 5 times, or actually, I think you go up to 3 times speed if you have a YouTube Premium account. But what you're going to kind of notice is that, that's kind of how this is what we're always going to go back and be referring to. So we've got a lot of transactions here. We've got A through Q. We then have, we want to enter the transactions in a T accounts, prepare an unadjusted trial balance, prepare an income statement, prepare a statement of retained earnings, close out temporary accounts to retain earnings. We'll get to all that momentarily. By the way, if you're looking at this problem first, I really want to highly recommend to you that you go through the other questions that I have in my study guide or the homework packet. Very, very important for you to kind of go through and to understand. So let's go through and take a look at this, this first question. And right over here, Avery, Jordan, and Taylor form Quest Response Services by each contributing $120,000 cash and receiving QRS common stock. QRS will provide consulting and investigation services. Okay, so we are QRS, and 3 individuals are giving us $120,000 each. So as QRS, what am I receiving? Well, basically, I kind of broke this down. I'm not going to do this on the exam, but these right over here are our asset accounts. I know the video is always going to get better when a cat joins us. Okay. So these are my assets, liabilities, equity. This is a dividend or base of what we're returning our capital to. Consulting services revenue. These are revenues and these are expenses. Okay, so everybody say hello to Ozzy. I'll do a brief stop share. We're gonna say hello to Ozzy. Yes, Ozzy, we're gonna show yourselves to the camera. We want to do that right now, Ozzy? No? Okay. Okay. So going back over here to basically over here to our question. So what's an asset? An asset is something that's giving us future economic benefit. If I look at Tesla, what are Tesla's assets? Well, it's cash and the cash equivalents. It is going to be short-term investments, accounts receivable, meaning that I've sold a vehicle and I haven't been paid yet. Inventory, basically my Tesla vehicles that I'm going through and selling. It's anything here that is giving us future economic benefit. What are liabilities? Basically, liabilities are basically those different items that essentially have to go through and be repaid. They're obligations. We say our assets are equal to our liabilities plus owner's equity. And our owner's equity is basically what our owners own after the liabilities have been settled out. Okay. So when I look at this question right over here, I'm receiving cash. How much cash am I receiving? Avery, Jordan, and Taylor are each giving us $120,000. So this is going to be 120,000 times 3, or this is going to be 360,000. So we record or we increase our assets basically with debits. So right over here, assets, I'm going to go ahead and increase my asset with a debit. So right over here, I'm going to debit cash for 360,000. For every debit, I need a credit. Is this a liability? No, they're buying stock. So if they're purchasing stock, I'm issuing common stock. Common stock is an owner's equity account. I'm going to show this increase with a credit. So whatever I'm going through in terms of doing the total amount of debits for every transaction has to equal the total amount of credits. Okay, so that's transaction A. Letter B. Morgan gives us $66,000. We will perform the services for Morgan in early 2030. So we are receiving cash, but we're not going to be performing the services up until a year from now. So what we need to go through and to do is we're receiving cash. Okay, so over here, I'm getting $66,000 cash. Cash is an asset. I'm going to show an increase to that asset with a debit. Go ahead and go here, 66,000. And I'm labeling this here, letter B. Do you have to label these? The answer is no, but if I mess up my work, I want to be able to go through later and figure it out. Okay, for every debit, I need a credit. Now, I have not yet performed the services, right? I've got money. I haven't performed the services. I therefore cannot recognize revenue. What is a very simplified definition of revenue is I've earned that money, I've performed the services. In this case over here, I have not yet performed the services. So this is going to be something called unearned revenue. And I'm going to come over here, call this letter B. Now, if we look over here at Tesla, and I was doing this with my class yesterday, you're going to see something here called deferred revenue. Same thing as unearned revenue. The answer is absolutely yes. Why does Tesla have deferred revenue? Well, Tesla used to sell vehicles that you could buy full self-driving in advance, I think for like 10 grand. Best invention ever. Tesla's not paying me to make this video, but it is by far getting my father-in-law, him getting around because he loves to dance tango. That self-driving function is absolutely amazing, and we're blessed to have it. So when it comes to deferred revenue, right over here, this is a liability. Why is it a liability? Because Tesla has not yet gone through and delivered those services. So again, same kind of concept here. This is going to be unearned revenue. Right? I really only record unearned revenue if I've received cash, right? I don't record it if I say invoice someone and I have not yet performed the services. Oh, Ozzy, there we go. Okay, you obviously want to get in on the action. See if we get, there we go. So we got unearned revenue like right over here. And so that's like letter B. Okay, counting is always better with cats. So sorry. Okay, on 2/1/29. Riley contributes $18,000 cash, and then basically QRS issues them stock. So what am I receiving? I'm receiving cash of 18,000. For every debit, I need a credit common stock. Okay. Note here, you could basically be getting cash, you could be getting equipment. There's a lot of different things you could issue common stock for. However, please note that there are a lot of rules and regulations when it comes to issuing securities for privately held companies, right? Publicly traded companies have to follow very special rules because when you are selling securities to the investing public, lots of rules. But we're just doing this here as a simplified example. Again, that common stock shows the ownership that Riley will have in the company. Okay, let's go here to the next one. We pay, so this is kind of the inverse of letter B. We paid Parker $24,000 for services that they'll perform for us in 2030. Why do I kind of say this is the inverse? Is because like right over here for letter D, my cash is going down. I'm paying someone, so my cash is going down. How do I show a decrease to cash? I do a decrease with a credit. So right over here, this is going to be letter D, basically for cash. Now, for every credit, I need a debit. Well, instead of this is not unearned revenue, I have paid for something, but I haven't yet received it yet. So what this is going to be is this is going to be prepaid consulting services. So right over here, I'm going to debit prepaid consulting services. I am getting a future economic benefit because I'm entitled to receive these services, and that will be sometime next year. Okay, so that is letter D. Okay, so we've gone through, we've done these first four. Let's go to the next one. Letter E. On 4/15/29, I perform services for Cameron, and I send Cameron and I send an invoice for 210,000. Okay. If I've performed services, right? So I've done work. At that point in time, and I've earned that, I performed the services, I need to go through and record revenue. How do I record revenue? I'm going to record it with a credit. So what I'm going to do over here is I'm going to go ahead and look for consulting services revenue. I'm going to record this basically for 210,000. Okay. Now, for every credit, I need a debit. When you see the term invoice, this basically means I generally have not yet received payment. It's an obligation for me to pay. So similarly, if Tesla sells a vehicle on account, they would be going through and recording the revenue. They'd have to do some other things for inventory, but then they would also be debiting accounts receivable. So right over here, we're going to go ahead and debit accounts receivable over here for 210,000. Right over here, accounts receivable is an asset. It means that the customer, basically, it's giving me future economic benefit because that customer is going to have to go through and pay me that cash. Okay, so that takes care of letter E. Let's go again and go on to letter F. Okay, so over here, letter F is that Reese is providing services to us. So again, the opposite of letter E, on account for $26,000. Okay, so by the way, really quickly, how did I generate this question? This question was generated with artificial intelligence. For those of you that are taking my classes, right over here, if I launch financial accounting, and again, this is not necessarily going to be 100% accurate, but it would say, do I record revenue with a credit or a debit? See what it says. Do I record revenue with a credit or a debit? Revenue normally is credit because it increases equity. And ultimately it does. Would you like a more in-depth explanation? Yes. So over here, and by the way, this journal entry is completely incorrect, and I'll kind of show you why that is. But let's kind of go back over here to our question. So, so this is obviously, so letter F is that they're providing us services on account for $26,000. So in this case over here, it's basically if someone's giving us services, this is going to be called consulting services expense, right? It's not a prepaid. I'm not getting it in the future. Someone's providing it to me now. How do I record expenses? I'm going to record those expenses with debits. So I'm going to go ahead and debit this over here for 26,000. For every debit, I need a credit. It's being done for me on account. So right over here, I'm going to be going through and crediting accounts payable, right? It's an obligation I have in the future to pay. So that is how I'm going to go through and record this particular transaction. Okay. Now what's payable? Accounts payable or AP. This is a liability. How do we show increases to our liabilities with credits? I have to pay this person back. They've done services for me. I have not yet paid them. Again, it's the inverse of what we saw with basically with accounts receivable and revenue. Okay. So no one. Okay, that's kind of creepy. Okay, let's go through and see what happened here. Just give me a moment. Okay, so we've got over here, we've got Reese pays, provide services to QRS on account for $26,000. So I'm basically debiting consulting services expense for $26,000. I'm going through and I'm basically crediting accounts payable because I have not yet paid for it. Okay, letter G. Okay, so Cameron pays $180,000 related to the transaction in letter E. Okay, so basically I'm getting $180,000 cash. Okay, so right over here, letter G, I'm receiving $180,000. For every debit, I need a credit. Now, the biggest mistake I've seen students make is they'll want to go through and record more revenue. That's not the case. Rather, when I recorded the revenue, I left an account receivable for $210,000. Once Cameron pays me $180,000, do they owe me $210,000? The answer is no. So the cash is going to be an increase to my assets, and my decrease is going to be to my assets. It's going to be over here at $180,000, and this is going to be transaction G. Okay, so I'm decreasing this now. How do we know that this makes sense? Well, if I subtract the smaller from the larger balance, my remainder is $30,000. So I know that I have done this correctly. Okay. Now on 7/129, we pay Reese $17,000 related to transaction F. Okay, let's do the easy part first. What's happening to my cash when I pay somebody? Well, if I'm paying someone cash, cash is an asset, it's going to decrease. I decrease my assets with a credit. So I'm going to go ahead and credit cash. And by the way, this is a really common thing in accounting. People go, I got a credit to my account. No. It's in accounting, it's very, very different. Okay. So over here, we're basically crediting cash for 17,000. Now for every credit, I need a debit. Similarly, with accounts receivable, well, before I owed this person 26 grand. Do I now owe them 26,000? No, I don't owe them that because I just paid 17 and the amount that I now owe is going to be 9,000. Okay, so that's how we go through and record that transaction. Okay, letter I. I declare and pay a cash dividend. Now, here's something else I'm going to tell you too. One of the things I do intentionally in the first in financial accounting is to make things more simplified. When we get to a later chapter, we're going to learn about how dividends, there's like a date of declaration, date of record, and then date of payment. Also, too, for revenues, I kind of said we've just earned it, meaning we've performed those services. By the way, first two exams, we're only going to be performing services because if we sell inventory, it involves another step. That's exam 3. One of the things, though, is when we look at revenue, Okay. So the real way we go through and record revenue is to basically list out these 5 steps, is to identify the contract, identify the performance obligations, determine the transaction price, allocate the transaction price, and recognize revenue. This I leave for intermediate accounting. It's too much for you right now. What I want you to do is just focus as we've gone through and we have earned it. Remember, what happens with this class, once you take financial accounting, it becomes a year of intermediate accounting, and I have plenty more videos for you when we get there. Okay, so here I'm declaring and paying a cash dividend of $42,000. My cash is going down by $42,000, so I'm going to credit cash. What do I debit? I'm going to go ahead and debit dividends. Now, one of the things about dividends, it's not an expense, although we do treat it like a good expense, we're going to report it, but it's not a true expense because we are not required to pay dividends. In fact, if I looked at Tesla, I would be kind of surprised if they did in fact pay dividends. We can ask AI. No, Tesla does not pay dividends at all. Why are they doing that? Because they're basically using it to basically grow their company. So people do different things with their money. That's what Tesla's going through and choosing to do with it. So I am debiting dividends, and then I'm going to be going through, I'm going to be crediting cash. Okay. So, and again, one of the things you're going to notice is that as we go through and do all these questions, you're going to start seeing things that repeat themselves. There's only so many different ways I can go through and ask you different questions. So just remember that the more you practice, the better you're going to get. Okay, letter J. We have somebody performing services for us again on account, right? So if I look at this letter J, does that look a lot like F, right? It's exactly the same thing. So we're going to go ahead and do the same thing. Is I'm going to go ahead here and record more consulting services expense. This is going to be for 31,000. And then over here, I'm going to be going ahead and reporting accounts payable. Okay. So total debit equals total credit. Someone's performed services for me. I've not yet paid them. I owe them the money. So that's how we're going to go through and record it. Okay, so that's letter J. Letter K, I perform services for someone and I invoice them for 74,000. Does that look a lot like letter E? It absolutely does. Same type of transaction. Over here, I'm going to go ahead and debit accounts receivable for 74,000. I'm going to go ahead and credit consulting services revenue for 74,000. Okay, so I perform services, I record that revenue. How do I record revenue? I record revenue with a credit. They're not paying me yet, so I'm going to go ahead and basically debit accounts receivable. Remember, the more you write these out, the better you're going to get at it. Okay, letter L. Okay, so I loan Hayden $50,000. The loan will basically be due on 12/31/31, bears interest at 10%. Okay, right over here, interest and principal will be paid by Hayden on 12/31/31. Okay. Any type of loan payable receivable is going to be done, or equipment purchase for your first exam will always be done on December 31st. So therefore, I want you to ignore interest expense or interest revenue. Very, very important. And why is that? Interest is a function of time. If I am going through and preparing an income statement and a balance sheet on December 31st, and right over here, the loan is being made, I'm giving someone money on 12/31, there's been no time that has passed. So therefore, right, don't worry about the interest for exam one. By the way, this is really what drives or grinds my gears. If you know Family Guy, what grinds my gears is when I see, well, when I can't find the drawers I'm looking for. But the other part is when, say, for example, I am, trying to, I look at these textbooks and they say, well, on December 9th, you purchased equipment and then there's no depreciation. It drives me bananas. So again, I'm trying purposely keeping things a little bit more unrealistic, but it makes it more simplified and hopefully it's going to be easier for you to understand. So if I'm loaning someone money, that means my cash is decreasing. So I'm going to decrease cash over here by $50,000. For every credit, I need a debit. What am I going to debit? Well, if I'm loaning someone money, that means they're going to have to pay it back to me. So this is basically going to be a loan receivable. Now, for my first exam, if you're taking my class, not with other professors, I'm generally going to be okay with you saying, well, if you call it accounts receivable, even though that's not technically correct, I'm going to be a little bit more lenient. Okay, but generally it's going to be a loan, right? If you're seeing someone loaned money, then you know it's going to be a loan. Okay. Now in this one, I receive a loan from Blake for $36,000. So I'm receiving cash. So my cash is going up by 36,000. Okay, so I'm debiting cash for 36. I have to pay them back. So in this case over here, I'm going to be crediting loans payable. Now, on your exam, can you do this? Say LP, absolutely. I know you're not referring to a record, but it's going to be loans payable or dad humor or LP. Notes payable is going to be NP. Okay. So over here, basically I received a loan from Blake for $36,000 and we've kind of taken care of that. Now for this one here, I'm going to go ahead and actually do the journal entry because this is really important to show you. So on 12/31/29, I purchased equipment for $60,000 by making a 20% cash down payment and signing a note payable for the remainder. The note payable will be due 3/31/30 and bears interest at 12%. Again, ignore the interest because all these transactions are happening on December 31st. But what am I receiving? I'm receiving an asset in the form of equipment, right? It's equipment unless it's a BMW. Gives me future economic benefit. So I'm going to basically show that increase here to the equipment with a debit. Okay, so I'm going to come over here to equipment. Okay, this is going to be for 60,000. Now, how am I paying for this equipment? Well, it basically says I'm making a 20% cash down payment. So I'm going to take 60,000, which was the equipment cost. I'm going to multiply this by 0.2. So my cash paid is going to be 12,000. And this is going to be letter N. Make sure I got that correct. I did not get that correct, so there you go. But I've got a problem. My total debits do not equal my total credits. I need another total credit for 48,000. This says here, I put it onto a note payable. So I'm going to go here to notes payable for 48,000. Now, I did share with you that I wanted to kind of take out a little time and kind of show you something as it relates to this transaction. And more importantly, is how we go through and record things as a journal entry. Okay, so let's go ahead and take a look at this one in particular. So on my exam, if you're taking my class, generally the way that I do it is I give you one of these large problems. But then what I'm going to do is I'm going to give you smaller questions. And when I give you smaller questions, it would be something like prepare a journal entry. So I'm giving you a lot all at once, and I'm trying not to overwhelm you because accounting is overwhelming as it is. So when I go through and do this, what did we do? Well, we debited equipment for 60,000. Equipment's an asset. I show that increase with the debit. I'm also going to then be crediting cash for 12,000, and then I credited notes payable, which is a liability for 48,000. My liabilities are increasing by 48,000. My cash went down by 12. Now, if I ask you to do this as a journal entry, I'm very particular about how we do journal entries. And what you're going to see is you would see a form that would look like this. So again, if you're taking my exam, this is kind of something how you would see it when it comes to basically the journal entries. Okay, so you would see something that looks like this. Basically, what a journal entry is it's basically we're taking what we put in the T accounts and we're kind of aligning this up. So if I went through and look at it like this, like, well, if I move my equipment to here and I'm going to put a T account right up here. Okay, I debited that equipment for 60,000. Over here, I'm crediting cash for 12,000. Now, what's really important is when you do journal entries, if you're crediting an item, you have to indent the account description. You have to credit the cash. I also have to credit over here notes payable. Now, you also might be saying to me, hey, Bennett, can I use N/P? Absolutely. No promises. Okay. So I'm just kidding. So this journal entry is essentially how we go through and we're basically summarizing what we went through and did in the T accounts, right? But if we kind of think about it, why do I have you do T accounts instead of journal entries? Well, T accounts are a far better visualization on how to learn it, right? So like right over here, it's like, oh, I'm getting equipment. I show that increase over here with a debit, right? And then over here, my cash is decreasing, cash goes down, cash is an asset. I show decreases to cash with a credit. So again, I do this as a visualization. In reality, this is what you'll be doing. Now, when I do journal entries, I also have to say some other things too, right? I have to show a date, so this is going to be 12/31/29, and then I need a description. So this goes out to all my friends at Irvine Valley College. If I say something like the new scheduling system is a disaster, okay, that is absolutely a true statement because it's been awful for our senior administrators and our staff because we chose to implement something which had not been fully tested. But that's going to be the wrong answer. What I do at journal entry description, I can just call it to record purchase of equipment. That's all you need to do. So I just basically say here for purchase of equipment. That's all I'm doing here. Okay, so let's go ahead and move on. Right over here on 12/30/20 I purchased an insurance policy for 18,000. Okay, so I paid $18,000 cash. So over here, this is going to be for letter O. For every credit, I need a debit. What do I want to debit? Well, I have a couple choices here. What I have the choice of is I've got over here, and I probably would mess you up by basically saying insurance expense. Okay. I can either choose prepaid insurance or insurance expense. For exam one, it's always going to be prepaid insurance. Why is that? It's basically because the policy coverage is in the future. It's from 1/1/30 through 12/31/30. It's in the future. This is what we call prepaid insurance. So prepaid is something that's giving me a future economic benefit. I showed that increase to basically to insurance with a debit. So right over here, this is how we would go through and see that. It's not insurance expense because I have not yet used it, right? So if you ever see insurance expense on exam one, it is a trick question. Okay. So that's letter O. Letter P. I pay my internet and utilities bill for $24,000. The bill covered from 10/1/29 to 12/31/29. Easiest thing here, what's happening in cash? I pay my bill, my cash goes down by 24 grand. For every credit, I need a debit, right? I've used internet and utilities. This is what we would call an expense. Now, why is it an expense? Because it happened during the time period we're preparing our financial statements for, which is basically for the year ended 12/31/29. So I'm going to go ahead and basically debit utilities expense. If you wanted to call it internet expense, by the way, if you're taking one of my exams and you want to say, hey, Tchaikovsky, I don't like that name, cross out and use your own, right? But just make sure you're calling it an expense. Now, lastly, letter Q, I'm preparing, paying $21,000 to Dakota for the transaction referenced in J. Okay, so here I'm paying someone, my cash is going down. I'm going to show that decrease with a credit. For every credit, I need a debit. So over here, I'm going to come and say, okay, do I still owe Dakota $31,000? The answer is no, I only owe them $21,000. Okay, so right over here, I'm going to go to my accounts payable and letter Q, and that's where that one is going to go. Okay, now, if I think about it, I owed Dakota before 31, paid down 21, I now owe her 10, which is what's reflected in part of the accounts payable account. What I'm going to do now with you is we're going to do kind of more of the boring part. And when you look at point distribution for exam 1, what we just did here, huge amount of the points. And one of the things I'm going to share with you is when I go through and grade exams, one of the common things I go through and see with students is that they'll do really good on this part, but then they're going to fall apart on the rest of it. So what we're going to do is we're going to do really well on this part, and then we're going to go ahead and finish up the problem. But I'm going to do the unadjusted trial balance. Then I'm going to make a separate video following this that goes through the second part. Okay. Now, what do I do once I've done this, right? I'm going to be making an unadjusted trial balance. When I make an unadjusted trial balance, I want to be very careful about how there's no right or wrong answer. This is only worth 1 point. But what I want to do is I want to set myself up for success. How do I do that? I'm going to basically say assets, give myself plenty of room, liabilities, owner's equity, some stuff. Dividends, revenues. Reason why I'm setting it up like this is basically my balance sheet. This is basically for my statement of retained earnings, and this is my income statement. And when I look at this in terms of the ordering as to how I'm going through and preparing this, right, I'm kind of saying, okay, income statement, statement of retained earnings, and then a balance sheet. So what I want to go through and do is I want to make sure that I set this up, because of this part over here, if I organize it well, it's going to set me up for success on basically the future parts I need to do. So now, how do I do my unadjusted trial balance? Well, let's go ahead and first up, add up all of our cash. So we had 360 plus 66 plus 18 plus 180 plus 36, or 660,000. But I'm adding up all of my credits. And if you do not get to use Excel on your exams, I'm sorry. If I subtract the smaller from the larger balance, I get 452. So what I'm going to do is I'm going to total up my debits, total up my credits. On my exam, am I okay with you just writing 360? Absolutely, yes. Okay, so if that's what you want to do, you're more than welcome to. So I total up my debits, total up my credits, subtract the smaller from the larger balance. And then right over here, I have a balance from cash for 452,000. Okay, common stock. Common stock made my first issuance, then I made my second issuance. Common stock is part of owner's equity. And this is going to have a credit balance. Okay. The unadjusted trial balance is basically summarizing what is really it's kind of doing is we're basically checking. So we said, hey, do our total debits equal our total credits? That's why we go through and do this. Okay. Next one I'm going to do here is a loan receivable. I don't care about the ordering of assets at this point, but this is an asset, and it's going to have a debit balance over here of $50,000. Equipment, same thing. Equipment is an asset. It's going to have a debit balance of $60,000. My accounts receivable, I did perform services for 210, then for 74. I received 180, so my AR balance is now 104. So right here, accounts receivable, 104,000. Okay. Accounts payable, total credits of 38, total debits of 57. Subtract the smaller from the larger balance, leave the remainder on the larger side. So liabilities, I've got accounts payable at 19,000. Again, you want to practice this because oftentimes you'll make mistakes by putting this in the wrong side. Consulting services revenue total of 284,000. That's part of revenue. And in fact, that will be the only type of revenue you have for exam one. Okay, I'm going to give you accounts that you will not need to use. Then we have over here unearned revenue. What type of account is unearned revenue? Unearned revenue is a liability. I've received money. I have not yet performed services. So this is going to be over here at 66,000. My consulting services expense is going to be at 57,000. Notes payable, liability. This is going to be over here at 48,000. Loan payable, another liability. This is going to be at 36,000 credit. My dividends over here are 42,000. And then over here, my prepaid insurance is an asset. So this is going to be over here at 18,000. Remember, it's an asset. I have not yet received the benefit of that insurance coverage yet. Prepaid consulting services, same thing. I paid for something I've not yet received the benefit for. Okay. And then lastly, we have over here, we've got utilities expense. Okay, so one other thing I want to kind of just talk about really quickly is the account of retained earnings. So as you've kind of seen from basically additional practice one, really it's additional practice two, which is a more simplified question. The way the income statement and the balance sheet connect is going to be through retained earnings. So as we go through over here and look at this, right, in my exams for exam one and exam two on these larger problems, retained earnings will always have a zero balance. So we're going to start retained earnings with a zero balance, and we'll go right there. Okay, so as I go through and total these up, right, and this kind of, I added these up already, I know I've done this correctly if my total debits of 831 equal my total credits over here of 831. Now, if I messed up something, right, what I want to go through and do is basically to check my work. How would I check my work? If I've been labeling these transactions like A, B, B, C, C, D, D, I'm going to be in a much better situation. So that is the very first part of this video of how do we go through and record transactions? How do we make an unadjusted trial balance, which is a lot of work for essentially just for these two first parts right over here, but it's absolutely necessary. You have to go through and practice these because what you're going to see it's going to happen is that everything repeats itself. So have a great day. I'll see you on the next video, and I'll see you shortly for part two.